The economy is about to go off a cliff. And I don't think the market is yet prepared for it. So let's go back to this Jackson Hole thing. What did they tell you? They didn't tell us anything new. They said, we really want to get to 4% and hold it there depending on the data. Well, the bond market, if I look at euro dollars or Fed funds, they're already at 4%. So the market's priced that. So there's nothing new. So I think, okay, there's nothing new there. So if the economy starts getting weaker, because the Fed said they will be more data dependent, then we'll see the bond market starting to price in lower rates in the future. So I'm looking at that. And then the Fed said, well, they will change their mind if inflation comes down a lot and unemployment goes up. So the forward-looking inflation data is already falling fast. My work suggests it could go negative in 18 months, which is something I've been talking about a while when I've been looking at, for example, the example of 1947, when people all came out of World War II, went back into the labor force, much like the pandemic. We had no supply because nobody was making everything because everybody was at war. We had this, prices went up 20%, 18 months later, negative 3%. Then it had a rebound effect and then balanced out. I think we've got something similar playing out now, which is contrary question. And again, when I look at forward-looking employment stuff, just the housing surveys alone, housing is the 5th largest employer in America. It looks like that they will start laying off workers pretty fast because they've got massive inventories. Everybody from Amazon to Walmart said we've got too much inventory. They're all laying off staff. Everybody's starting to lay off staff. All the tech companies are laying off staff. So I think we're going to start to see unemployment and inflation falling, the economy falling sharper than people expect. We're already seeing oil weak. We've seen all the commodities weak. Many of them are now negative year on year or close to it. So we've got this storm where bond yields are still high. They're actually, most assets year on year map the ISM really well. It's amazing. The business cycle is like this voodoo magic. And many people can see my threads on Twitter. I write about this a lot. I talk about it in Real Vision a lot. Is the year-on-year rate of change of the S&P, the NASDAQ, the bond yields, copper, oil, emerging markets, credit spreads, that all map the ISM. So right now, where are asset markets pricing? Well, interestingly, bond yields are pricing the ISM at 63. So they're way above where the market.
What does that mean, Raoul, for people who don't follow?
In a sharp recession. The bond market is not yet doing so. The only other one that's lagging is oil, which is in line with current ISM and not future ISM. Everything else is pricing future ISM, i.e. recession. Oil's not pricing in a recession yet, and the bond market's kind of in la-la land. Now, I usually say the bond market is the truth, but at turning points, it can often be wrong. And it tends to lag because this inflation narrative digs its heels in. And we've seen that in 2000, we saw it in 1990, we saw it in 2008, we saw it in 2018. The bond market deviates from ISM. ISM starts falling, and then this Wile E. Coyote moment, and yields start collapsing. Now, why do I care about yields collapsing? Well, I've just told you that asset markets are actually pricing in a full recession. And I know there's a narrative out there that the markets need to price in a lower leg from earnings. But when I look at it in my terms using the business cycle, I think it's already priced lower earnings. So if bond yields start to fall, then financial conditions are easing. And the chances are the growthier end of the world, NASDAQ, crypto, growth technology plays will start outperforming. And we've seen many of those bottom a while ago. When bond, now we need to see that play out. Tomorrow, day after tomorrow, is the ISM survey. I'm expecting it to be weaker than expected, but it could play out the following month. You know, economic data, 1 month to the next isn't a lot of data series or wiggle room. So let's see what happens. But the next couple of months, I'm expecting it to be signaling a full. So the tipping point where bond yields start to fall, it'll start affecting asset markets. So I'm not a believer we go to new lows. I've done surveys after survey and seen all the surveys on Twitter. 70% of all respondents in crypto and macro think equities go to new lows. Now, if that is the case, then most people are positioned for it. So therefore, the path of pain is the opposite. And I think the market's priced that in. So I think there's no certainties in this world. I can be wrong, but my view, the balance of probabilities are for me that the risk asset market, equities, crypto have bottomed. We are having a retest. And as the economic data shifts and bond yields come down, that'll drive that further, and it'll be a further hated rally because nobody will understand. We're going into a recession. Why are equities going up? Well, because they already priced the recession. It's their job to be forward-looking indicators. So that's kind of the big picture framework. The record peak number of people hitting 65 in the US labor force. And that means peak retirees. So we've got peak retirees happening, and we've got demand destruction driven by this economic cycle. So the forward-looking inflation data to me looks like, if I look at commodities, I look at a bunch of things like new orders versus inventories in ISM, that they go negative. Okay, that's the extreme. That's actually my base case. Maybe I'm wrong, but inflation's coming down significantly and very fast. So the next part is so what is the macro driver of crypto? Well, inflation doesn't help because it's taking money from your pocketbook and not allowing you to allocate money into crypto because it's a retail driven market. It also creates a lack of liquidity because the Federal Reserve, to stop the inflation, have been taking liquidity out of the system. So that means institutions and hedge funds have less liquidity to put into the system, and therefore less flows into risk assets like crypto. I found the best approximation to be money supply growth, M2, year on year. And year on year M2 looks like it's potentially turning up, global M2. We're already seeing that China is going to start picking up M2. We're already seeing that Europe is going to start stimulating through the back door, which is they're going to have to offset the electricity prices, the difference between electricity and gas prices. And they're also giving direct transfer payments to people to pay their electricity bills. So I think that monetary policy changes. It also lags ISM. It's kind of a weird thing, and it tells me that M2 bottoms right about now, which is what the crypto markets, I think, have been telling us. They're trying to find this bottoming process. And if I'm right, the economy slows down, liquidity is going to come up, and crypto is going to rally from here. Let's see. But again, I think crypto has put in a low. I think the ETH merge is a very big deal.
Yeah.
I think it's going to drive inflows. Yes, there'll be volatility. Yes, it won't be a straight line. But I think over time, it's going to put some security into the space because it's done and out of the way. Let's see. Let's hope there's no risk around this. It'll die some of the FUD narratives that are currently building as we move into this, which is only normal and people should question it. And then we'll see on the other side, when you've got this yielding asset that is a giant in the space, what that unlocks in terms of DeFi, the opportunities for institutions to invest, and other opportunities that come from a different asset. Also the ESG credentials. You know, we all hear all the time, liquidity. How much money is available or how much is not available? So when the amount of money is growing, well, there's money everywhere. We can do stuff. Now, it means that it's easier to borrow money from your bank. It's easier to get a mortgage. It's easier to do all sorts of other things. But it also means that businesses have easier access to capital. Banks are not hoarding capital as much. So it means that money flows throughout the financial system. We're a system based on leverage and liquidity. So when money supplies down the world at the same time, it means that it's going to pull down all assets. And in fact, when we look at it, the bond market has lost $19 trillion in value globally. The equity market's lost $21 trillion in value, let alone, you know, real estate, crypto, all of these things. We've lost something like 40% of global GDP in this pullback. I mean, that's a lot of wealth that's been destroyed. And interest rates getting very far. I mean, the US interest rates are 2.5% and bond yields are at 3%. But that's the problem of a leveraged market. So when you take liquidity away from a leveraged market, if you're paying the interest on your loans and you're not got enough money, so imagine you're trying to pay your mortgage, but your salary keeps going up and down. So i.e. the amount of money you've got is suddenly less, which is what's happening with inflation. It's harder to pay your mortgage, so you won't borrow or spend as much money. That's what liquidity does. So it's M2 is liquidity. Liquidity going up is good for assets. Liquidity going down is bad for assets. Liquidity negative, where it is now, has been particularly bad for assets, which is why we've had a bear market and we're pricing in a recession that are denominated in dollars. So the dollar going up is bad for the rest of the world. So it's good for the US because you import more goods than you export, therefore the prices of goods goes down. For other countries, it's kind of inflationary, but what happens is they export stuff. So Asia is the big exporter. If their currency is weaker, it's also going to bring down the rate of inflation over time because they're selling goods. If the dollar goes up 20%, automatically their goods are 20% cheaper. So if you're importing them into the US, they become cheaper, importing into Europe or whichever countries. So it is good for lowering inflation. It's bad for asset prices. It's slightly complicated. And because of the amount of dollar debts, people need to be very careful of the dollar getting too strong, too fast, because it blows shit up.